I want to try out a new hypothesis on a fairly well-worn theme in capital markets today on this video, and that's the following. The theme of de-siloization, de-siloing, defragmentation, primarily aimed at large, complex dealing banks and financial intermediaries on the sell side. I had always thought that de-siloizing meant breaking down all those silos of business activity and risks and making them all work together much more seamlessly and on an enterprise level. And what I want to try out here today is the idea that maybe some of those silos are just going to be jettisoned from the sell side to the buy side. So I'm here today with Avadhut Naik from Quantifi, a product manager, and someone who, as you deal with your clients and prospective clients, you see this migration. Tell me what you see in terms of the nature of portfolios and certain kinds of risks that may be moving from the sell side to the buy side.
We do come across this. I mean, this is one of the aspects in the larger impact of regulation and regulatory directives on the buy side. We see this typically for books like the correlation book, for example, which is like there is a huge regulatory capital charge that the sell side needs to take to hold on to that book. So the sell side is interested in getting that risk off their balance sheet.
Right.
And that is where the buy side, there are firms in the buy side which are looking for an increased, a higher return in a low interest rate environment.
Right.
So that's where some of those trades are happening, where there is risk shifting from the sell side into the buy side.
Now, in terms of the toolkit that, say, yesterday's buy-side player that might want to contemplate absorbing some of these risks, talk a little bit about the toolkit, yesterday's toolkit, and the toolkit they need, the platform they need in order to assess this expanding spectrum of risks that they've never had to try and manage before.
Yesterday's buy-side firms were focused on a limited number of asset classes and a limited number of strategies. We see that changing. We see firms wanting to have the ability to be multi-asset, to manage their risk at a multi-asset level. We see the need for an integrated solution that will give you a holistic picture of the risk across multiple asset classes. And in general, the sophistication of the analytics.
In terms of newer entrants, I would think that the message is that your risk platform needs to be much more holistic in nature in terms of its ability to net out risk, to look at both market and credit and the cross-pollination where the new opportunities may be. Why don't you talk a little bit about that as a hypothesis for when you start out, you still need to have this more holistic functionality.
Yeah, that's a very interesting point. What we are seeing is the funds that are newly starting up, the new buy side firms, are looking for what we like to call a next generation of portfolio management tool that covers the analytics, the trading, and the risk management piece. In risk management, it is more of like enterprise risk management, so a tool that will address market risk, credit risk, and liquidity risk together. Right. As far as trading goes, they're looking for pre-trade analytics, something that will do pre-trade analytics, trade lifecycle management, as well as modeling, collateral management, and clearing is getting very important. So initial margin, variation margin modeling.
Right.
And in general, a better analytic tool set across asset classes. So
right.
A newly starting fund would look for a single solution that could give them all of these things.
So this isn't just a broader spectrum of product. This is actually a broader component of the workflow from pre-trade, right? So in other words, historically, you'd have to bolt together several systems potentially to cover pieces of that workflow or across the various products in order to achieve this functionality. And you'd have to get all the back-end infrastructure to cooperate with that. And so you're suggesting that it's possible to have a much more integrated piece of functionality platform right out of the box.
Yeah, absolutely, and it is the what the buy side firms are looking for. They don't want the extra overhead of managing multiple systems.
Yeah. Yeah.
Portfolio managers having their own analytics systems, and then the risk managers and operations having the trade management systems. Instead of that, they would very much like to go for an integrated system that is easy to implement, easy to support, leads
Right.
to lower total cost of ownership.
Right. Feeds
And
into the whole more for less theme that we see almost everywhere these days.
yeah, and most important, gives them an integrated view of their P&L and their risk.
Is there any, I know that a lot of this is still very new, but in terms of building upon even this value proposition, which access do you build on? Do you build more of the workflow in terms of maybe some of the research into signal generation or cross-product pattern recognition, maybe some quant add-ons, or is it even further spectrum in terms of regions or products? Where do you stretch even this broad enterprise and holistic view from here looking forward?
I think it's very difficult to predict where the market will go, but as long as the solution is holistic and there is flexibility in scaling it along different dimensions,
Yeah.
I think that's what everybody's looking for.
Good. I want to bookmark it there. That's a lot to digest, especially when you follow the migration for how the sell side jettisons, defragments, the risk ends up on the buy side, and that creates a whole new level of creativity and innovation about how to manage a broader spectrum. I think is really a fascinating narrative that we seek to track quite a bit more closely moving forward. So I want to thank my guests, Avadhut Naik from Quantifi. My name is Paul Rowady here at TABB Group. Thanks for watching.